Back on Morning Mover, shares of Nvidia down more than 6% in the pre-market after the company says it will take a $5.5 billion charge related to new export restrictions on its H20 chips to China and other countries. Piper Sandler, Raymond James, and D.A. Davidson all lowering their price targets on Nvidia on this news. Time now for Options Corner. Joining us to take a deeper look at Nvidia, we've got Rick Ducat, lead market technician. All right, Rick, looks like there's some pain to come for Nvidia, but what are the trends that you're paying attention to on the chart?
Yes, so we can see that Nvidia has broadly outperformed, much of the market here, but especially its own sector, which underperformed our benchmark S&P 500. So tech weaker than the broader market, but Nvidia stronger than both. So now we can see that if we were to shift over to our candle chart here, for the most part, Nvidia has been trending down off of these highs that we established near 153.13. The downtrend had also accelerated in recent weeks. You can see we have a steeper blue trend line within our channel here. But it's looking like after our tariff news-related dip that took us down all the way here past our notable August 5th lows, probably a kind of a scary moment for a lot of bulls there, and took us below our channel, we have rallied. We have recovered above our yellow 21-day exponential moving average. We have stalled out so far, though, at this red line. A low point here, another low point here, and then high points here. Around 113.37. Also lines up quite closely with our purple 252-day exponential moving average, which is just below 115. Notice as well that even though price has recovered, RSI has not broken out above its long-term downward sloping trend line yet, and also has not made a convincing push above that 50 midline. We did close above it, which is a bullish signal, but it's a very, very, very slight, modest push above that level. Now, volume profile point of control shows greater emphasis near that same area we were just discussing, as well as that -1 standard deviation channel. So around 119, this is the big area to work through here. Around 115 to around 120 or so. There's quite a bit going on in that region, Diane.
All right, 115, 120 area to work through. Not going to be today, it doesn't look like. Thanks, Rick. All right, to take us through an example trade, let's bring in Tom White, senior options contributor and co-host of Fast Market. So how would you go about an example trade for Nvidia in the context of this news it gave of this $5.5 billion charge?
Well, you're seeing the big pullback here, Diane, not surprisingly on that news. How much more does it have to go? Remember, just over a week ago, this stock was below, $87 a share. So it's come back pretty well. They've got earnings at the end of May, so we've got some time, some duration on this one. But I looked at a strategy because I think a lot of people are going to look at this 6% pullback today and say, hey, I'd like to buy it, but hey, there might be some more volatility. There might be a little bit more downside. What strategy can I use in the option market to take advantage of this pullback that we're seeing, and most likely a spike in implied volatility level? So I looked at a strategy that takes advantage of it, where it's a twofold type strategy where, hey, if the stock stays right here, goes higher, or even goes a little bit lower, I can still be profitable, or I'm comfortable owning the shares if it goes lower. So I looked at a cash secured put. This is a neutral to bullish type strategy where I'm going to go out to the May 9th weekly cycle. So 23 days to expiration, just over 3 weeks. You're going to avoid that earnings event. You'll have some other tech earnings within there, but implied volatility levels are elevated. So selling the May 9th and going down to the 100 strike. I'm going to collect a credit if the stock opens up about 105, just below 105, where it's currently trading right now. You're going to be able to collect about a 375 credit on that one. So what does that mean? Well, if I'm selling the 100 strike, you subtract that 375. It takes my break even where I start to get hurt to the downside about 96.25. That's about 8% below the current share price in Nvidia. So you've got some cushion to the downside before you start getting hurt on this, but it's capital intensive, right? Because if the stock does fall below 100, you're going to have to buy the shares at that 96.25 level if you're still short that put into expiration. You can always close it ahead of time if the market's open. But you can see here from the risk profile, it gives you that profitability of $375 per contract that you sell on this, with the expectations it remains above that 96.25 level, that 8% cushion to the downside. If it just stays here, goes higher, or goes near that $90 or that $100 strike, you get to keep $375 in profit on this type of trade. So it's twofold. You got to be prepared to own the shares, but you're owning them at an 8% discount to the current share price, which is down 6% this morning.
Okay, yeah, it's certainly under some pressure this morning. Thanks a ton, Tom, for that example trade. We are continuing to watch futures under pressure, especially in the tech sector. Nvidia dragging that down. You've got AMD under pressure as well.